All right, well, good morning, good afternoon, and good evening, depending on where you are in the world. Thank you so much for joining the Global Blockchain Business Council's Legal and Regulatory Group's webinar on regulatory considerations for crypto exchanges, hosted by legal experts from GBBC member Norton Rose Fulbright. Throughout today's conversation, if you have any questions, we encourage you to enter them in the Q&A box at the bottom of your Zoom screen. And so without further ado, I'll hand things over to Hannah Meakin. She is partner at Norton Rose Fulbright's London office. Thank you.
Hi, everyone, and thank you very much for joining us. This is going to be a webinar on the regulatory considerations that are relevant to crypto exchanges. So if we turn to the next slide, I will explain who we all are. So I'm going to moderate this session. I'm Hannah Meakin, one of the partners in the financial services team in London, but I'm joined by colleagues from a number of our offices around the world. In fact, we're all financial services practitioners and we all work on a range of FinTech matters alongside colleagues from other disciplines. But in terms of who we have on the webinar today, we have my colleague Albert Wetherill, who's also from our London office. We have Floortje Nagelkerke from our Amsterdam office, and is going to give us hopefully an insight into the European perspective more broadly. We have Atelka Bagadi from our Hong Kong office, so she's going to give us a bit of an APAC perspective, and also Ron Smith from our Dallas office, so he's going to look at things from through a US lens. So if we can move on to the next slide, please. Thank you. We really wanted to do this webinar because we wanted to talk about crypto exchanges, because we kind of think that they're a really important part of the infrastructure and trading functionality, and really kind of integral to the wider market infrastructure in which all asset classes, but including crypto assets, both now and going forward, are traded, and really kind of important to making that environment, that infrastructure, that ecosystem work. So we've all worked with exchanges and other trading venues in traditional asset classes, or what we're probably going to refer to throughout this webinar as traditional asset classes, by which we mean everything other than crypto, I guess. But we really see crypto exchanges as giving rise to many of the same considerations, but also many new ones. And that's why we think it's quite an interesting topic to talk about. So having now worked with those who either operate a crypto exchange or trade on a crypto exchange, or list their assets on a crypto exchange, or even provide support services to crypto exchanges, we can see that there are a whole kind of wealth of questions that come up. And interestingly, they do tend to be kind of similar questions being raised in different jurisdictions. So we've kind of put a few of those questions onto this slide. And they're kind of quite different questions, I guess, in terms of their nature. Some of them are quite philosophical almost, or really kind of looking at the policy behind what an exchange is really trying to do, and how it might operate. Some of them are maybe more practical in nature. But I think the point is that they're all pretty interesting questions. So during the course of this webinar, we're going to try and address or explore as many of them as we can. So we've kind of organised a few questions to try and answer between us, but we're keen to hear other questions and think about new angles and explore other possibilities. So if you do have any questions as we go along, please do put those into the Q&A functionality, and we'll either try and pick them up as we go along, or try and save some time at the end to have a look at them. So if we make a start, our first question that we kind of wanted to talk about is essentially kind of what types of crypto exchange are there? And it might sound like a basic question, but I think it's quite important to framing the scope of what we're going to be discussing for the rest of the webinar, because I think we're kind of all conscious that the concept of an exchange and the term exchange maybe has a particular understanding in most countries in the pre-crypto world in relation to traditional asset classes. But actually the way that trading is evolving in relation to crypto assets is maybe kind of broadening and expanding that concept of what an exchange actually is. And some of these boundaries or changes in boundaries could have implications for some of the regulatory issues that we'll be discussing. So I think there are a number of dimensions here, and we just wanted to touch on some of those. So Floortje, I might ask you if you can start off with one of our kind of first dimensions that we were thinking about, which is maybe the difference between multilateral and bilateral trading.
Yes, of course. So if you look at the legal framework, at least from a European perspective, there is a definition of what a multilateral system means and what it is. So there's a definition in MiFID II, which sets out that it's a system or a facility in which multiple third-party buying and selling interests in financial instruments are able to interact in the system. So MiFID really relates to financial instruments. So in relation to crypto assets, only if those crypto assets, of course, qualify also as a financial instrument. This really applies also to an exchange in relation to such assets. But then bilateral, so on one hand you have the multilateral, on the other hand you have the bilateral aspect. That is understood to be everything that is not multilateral. So therefore it is always very important to know whether a certain setup or structure will qualify as multilateral. And there have been quite some discussions when MiFID II came about in relation to the multilateral definition, and there has even been a question posed to the European Court in relation to a system that has operated by Euronext here in Amsterdam, whereby the court sort of explained that if there are indeed more than two parties involved, if there is an operator involved and an independent operator involved, then it in principle constitutes multilateral as a multilateral system. But also, if you look at then some of the Q&As published by ESMA in relation to an OTF, an organized trading facility, they also acknowledge that sometimes multilateral, sort of what is multilateral is not always as clear cut. And there they say if there are more than two people, or counterparties, let me put it that way, then there is a possibility for third-party parties to interact, which is still a bit vague. So they now published an opinion whereby ESMA proposes to implement the definition of bulletin board, whereby again, that is not considered to be multilateral, but more bilateral. And that has also been prompted by crowdfunding and crypto asset platforms, whereby the boundaries between the bulletin boards and trading venues have been a bit subject to the debate. Some of these projects are looking to offer a secondary market to the clients, and therefore there could be a discussion whether that would be captured by multilateral or not. So there is quite a bit of movement also in the European legal framework on whether or not something is multilateral and bilateral, which is also then explored in relation to the crypto asset exchanges. So there's more to come. There's now a consultation paper also published by ESMA by the end of January, which also touches upon what is multilateral. So it's not a clear-cut answer. And also if you look indeed with the traditional exchanges, typically they are indeed multilateral, but with the crypto asset exchanges, it's not as clear-cut. And I think the term multilateral and exchange is used more loosely there than with the traditional exchanges.
Thank you, Floortje. Yeah, so the kind of second dimension that we wanted to just touch on, and we're going to actually pick up on this one a little bit later on, is the distinction between regulated and unregulated platforms. So in the UK and also actually in Europe, as Floortje just mentioned, we have got several types of regulated trading platforms. And broadly speaking, the thing that makes them regulated is the type of asset that can be traded on them. So where regulators currently see crypto assets as being unregulated in several countries, it might not be necessary to be authorized or to have some kind of financial services license in order to operate a platform for their trading. And so you do have some crypto asset exchanges or platforms of different descriptions that actually don't need and therefore don't have, or in fact may not even be able to get a license in order to be able to operate. on the other kind of end of the spectrum, you do have some crypto assets that are regulated, and when you're operating a platform to enable or facilitate the trading in those, then you may well need to have a license. And so those types of crypto assets might be that they are regulated because they have characteristics that make them akin to regulated, traditional regulated assets such as securities or derivatives. Or it might be that they are instruments that kind of reference or relate to crypto assets, like, for example, crypto derivatives. And so those are the types of assets where facilitating trading in them may well, in many, if not most countries, be a regulated activity in its own right. So I'm talking here really about licensing in terms of regulated and unregulated, in the sense of needing a license or some form of authorization, as opposed to regulation for other purposes. So, for example, for anti-money laundering purposes, which we will actually touch on a little bit later. But I think it is kind of worth flagging this point because obviously it's very significant to somebody who's performing this type of activity to know whether they need some kind of license or not, but also actually for other users of these types of platforms as well, because I think in the traditional asset exchange world, we might kind of assume that an exchange is subject to some kind of regulation or maybe exemption in particular jurisdictions, but it's not necessarily a fair or safe assumption to make in relation to crypto asset trading venues. And therefore, I think it's one just to be aware of. So Etelka, maybe we could move to you, because I think you were going to talk about a bit more about the types of assets that we might find on crypto exchanges.
Yeah, absolutely. Hi, everyone. So generally, at least in my part of the world here in Asia, we're seeing spot and derivative exchanges usually in a combined way. So, there are certain products that are very heavily featured and in some ways developed out here in Asia, like the perpetual swap, for example. So we see that a lot. The securities token or tokenized asset exchanges usually operate separately from the former category, i.e. not really on a combined basis. This is primarily because there's still some regulatory and legal difficulties in the STO market. So it's really seen as a bit of a specialist field, at least out here in Asia.
Thank you, Etelka. And Albert, would you like to talk about I think Flutch kind of maybe led into this quite nicely, the centralized and decentralized distinction?
Yeah, sure thing. So I think this is an important characteristic of crypto exchanges that we typically wouldn't see in traditional financial services. So if you think about most, if not all, venues, by virtue of the regulatory arrangements connected to them, there will be someone who is operating that venue. They are centralized, and you'll typically find that person is the relevant party that produces the matching engine, that takes ownership of the rule book, that enforces the rules against participants, etc. So that party will also play a role in the sort of clearing of the relevant trades, in the settlement of the trades with respect to the exchange, in partner with relevant counterparties to facilitate that. In the crypto world, there's two models, as many of you will know. There is a centralized exchange. So, there is still that holdover from centralized finance, whereby some of the largest and highest volumes exchanges, Binance, FTX, Coinbase, are centralized. They are operated by the relevant entities. Behind those exchanges, they run with matching engine type functionality in the same way as many MTFs and other venues do. They will have rules and exchanges. They will admit various asset classes to trading on those exchanges, and they will enforce the rules of those trading against the relevant participants. They may have market makers on there in a traditional fashion. Many of those kind of have moved into the crypto market making space. So you will have participants on that venue who are providing liquidity, and the order book will reflect that, as well as obviously the consumer facing angle to the trades and the institutional clients who will trade on those venues. Where we have a difference in the context of crypto, however, is in the establishment and the kind of increasing popularity of DEXs, so decentralized exchanges. Here, you have an instance where there is no centralized operator. So in principle, the exchange is the functionality is determined by various sort of self-executing smart contracts. So, it's almost in some respects you have a slight, you have the functionality of the exchange, but without anyone really taking formal ownership of that. And I think in the context of DEXs, we've seen kind of two models. One is the kind of order book model. So again, similar, sort of taking almost the concept of a matching engine, which the operator would, in a centralized context would code and monitor, but deploying that in the form of a self-executing smart contract. So the order book effectively is the smart contract, and that helps track liquidity and arrangements on the exchange. And then also more sort of swap style execution, where things like Balancer, SushiSwap, Uniswap, where those exchanges have the relevant smart contracts, but they rely on a liquidity pool mechanism to provide liquidity. And often you'll find, effectively tokens that get locked into smart contracts to form the liquidity pool, and then you have kind of automated market making where the smart contract draws on those tokens to facilitate liquidity. And the benefit of locking your tokens is that you often generate some form of yield. And so, locking tokens into smart contracts for use on DEXs as automated market makers has been quite a popular sort of yield generation tactic in DeFi. Is one of the mechanisms you can put your unused tokens to work. So again, there are fundamental differences with what we see with traditional exchanges and also centralized crypto exchanges. So I think that demonstrates the real variance that we have, both in terms of operational approach, but also if we think about the regulation and the possible issues that may arise, how you can see differences between centralized exchanges and DeFi exchanges, and the latter obviously being particularly kind of problematic from a regulatory standpoint, because who would you regulate as the kind of base question. But they're the kind of key differences across that spectrum.
Yeah, thank you, everyone. I think that's absolutely right, that kind of some of these dynamics, and indeed probably other dynamics as well, can make the crypto exchanges and trading venues actually look quite different from the traditional asset exchanges, and actually also can make them look quite different from each other. So you get a whole kind of range of a whole kind of spectrum of different types of trading venues in the crypto area, which will be interesting when we look at the types of regulation that might apply a little bit later. However, before we do that, first, if we move on to the next question, we just wanted to look at how crypto platforms are actually regulated in each of our jurisdictions, or indeed whether there is any regulation around crypto exchanges specifically. So the question I kind of wanted to pose to my colleagues is to ask them to try and summarize, I guess, what are no doubt fairly complicated regimes in their countries, and obviously quite dependent on the fact patterns. But if they can maybe tell us some of the kind of relevant factors that are relevant to the way or the circumstances in which a crypto platform might be regulated, I think that would be really helpful. Flucha, perhaps we could start with you again, and maybe you could look at this from a European perspective.
Yeah, so in Europe, there's currently no specific regulation in relation to crypto exchanges other than the Anti-Money Laundering Directive, number 5, which requires registration for exchanges that facilitate transfer between crypto and fiat currency. So it's not a licensing regime, it is a registration, and all the member states have had to implement that registration possibility. It is laid down in the directive, which means that indeed, like I said, it needed to be implemented into each jurisdiction in its own way. So there are some differences. So therefore, it is good to, well, at least look at it from the member states that you may want to be active in to see what the registration really entails. For instance, in the Netherlands, it was quite burdensome, and the Dutch Central Bank has been quite strict, and it took quite a long time, or takes a long time, to get the registration in place. And that really relates only to, like I said, the exchanges that facilitate the transfer between the crypto and the fiat currency. We will have it is the proposal of the European Commission to have the so-called MiCA in place, which is the Markets in Crypto Assets regulation, which has a direct effect, so it doesn't need to be implemented And then is the reason for that is because it is assumed that then therefore there's really a level playing field throughout Europe and there's no discrepancies in interpretation. Well, we all know that that might not always be the case, but MiCA will introduce a license obligation and ongoing requirements for the crypto exchanges. If it is a crypto exchange that isn't currently already covered by the license obligation in MiFID II, so if it really only relates to crypto assets and which are not considered to be financial instruments, then you may need to get the license in place, because one of the crypto services or crypto asset services that are defined is indeed the operation of a trading platform for crypto assets, which that would mean that you would have to have that license in the member state that you are established as an entity. There is the definition of what is operation of a trading platform for crypto assets is managing one or more trading platforms for crypto assets within which multiple third-party buying and selling interests for crypto assets can interact in a manner that results in a contract. Either by exchanging one crypto asset for another, or crypto assets for fiat currency that is legal tenor. So that sort of leads back to what I just discussed on the concept of multilaterality. It's practically the same definition. So under MiCA, that still holds through to have real clarity on what is meant to be a multilateral system, also in relation to the crypto platforms. And it would mean that if you would have to have that license, well, you have to go through the whole process and provide a lot of information to the relevant regulator. But it also means that once you have that license in place, that there are ongoing rules and regulations that you need to comply with like I said, on an ongoing basis. And it will mean that certain rules that now are applicable to trading venues under MiFID II will also be in place for the crypto exchanges. So the rules in relation to the pre and post trade transparency, in relation to your fee structures, information should be transparent, fair, and not discriminatory. And also in relation to the access to the platform, there needs to be rules in place on who is allowed to access the platform and to enter into transactions. And of course, there are all kinds of rules then in place in relation to your systems and procedures and arrangements that apply to the operations of the system that is being used. So there's more to come. It's just a proposal, but it's still being discussed and agreed on. So it's not in place yet. Well, sort of, maybe, unfortunately, but it's a good thing to keep in mind. Also, a good thing to note that, like I said, this is a European proposal. A lot of member states already implemented their own legislation in relation to trading in crypto assets and the exchanges. So it is always worthwhile to check in the member states that you may want to be active, whether or not there are national rules that would need to be applied with.
Great, thank you, Floortje. Ron, could you maybe tell us about, at least summarize the position in the US?
Sure, absolutely. And I know I can't do this issue justice in the short period of time that we've got here, but generally, at a high level, it really depends on the type of product that's really being traded. And generally, the relevant legislation was enacted before really the contemplation of crypto assets at all. And obviously, there are a number of criticisms and proposals on the table to remedy what people believe are deficiencies with respect to regulation. But basically, crypto platforms could require registration with the CFTC if the platform trades certain commodities other than virtual currencies or derivatives. They could require registration with the SEC if the products traded are securities. However, if the platform limits trading to virtual currencies and complies with other certain requirements, it may only have to comply with federal and state money transmitter licensing requirements. And this is really what we're seeing as the commonplace route with respect to crypto exchanges. And that means that they need to comply with the Bank Secrecy Act, which provides a number of requirements for many different types of financial institutions, including those who transmit payments. They need to implement anti-money laundering and know your customer programs to comply with the BSA, and they need to report certain information to FinCEN, or the Financial Crimes Enforcement Network, which is part of the US Department of Treasury. And all of these comments are kind of at a high level of what should be done. There is quite a bit of debate about whether or not exchanges are actually doing these things, and that is really dominating a lot of the media attention in the U.S. I think I'll circle back to that in response to some future questions.
Great, thank you, Ron. Albert, do you want to maybe pick up on the position in the UK?
Yeah, sure thing. So I think, as you were sort of touching on at the beginning, Hannah, if you're trading assets which would be classified as security tokens under the UK regulatory framework, so they have the same characteristics as securities and other forms of regulated investment under English law, then you are performing. You would likely need to be regulated in the UK as an MTF to operate that exchange. If you are trading what the FCA considers to be unregulated tokens, or possibly even e-money tokens, and this would cover most of the largest market cap coins, then in that scenario, you do not need to be regulated in the UK under our kind of financial services and markets act regime, in the context of how a traditional exchange would need to be regulated. If you are trading, so therefore, if you are trading kind of crypto derivatives, or you're trading kind of crypto native products like perpetual swaps, I think the likelihood is you would need to be regulated, because most of those would be classified, as I say, as derivatives or CFDs under UK law. And so that's the kind of core regime. We also, as similar to Fortune has described in Europe, we have the UK version of NLD5, which imposes our crypto asset exchange provider regime. So in effect, if you are exchanging crypto assets for fiat or for other forms of crypto asset, then you would need to maintain a registration with the FCA. That registration is in reality a form of soft authorization. As many of you would have seen in the market, there's been a lot of applicants, there's been a lot of people drop out of that regime. It's taken even sort of highly reputable providers a long time to get through that process, and that's because of the intensity of that process. And as I say, the level of engagement is more akin to an authorization. So there is, for the time being, no formal operators of crypto exchanges just trading kind of spot unregulated crypto tokens are not regulated persons, but certainly they are moving along the spectrum, and they are now themselves subject to FCA oversight with respect to AML. But given the focus of the regulator here on AML, I think that is, it's moving closer to it being something akin to an authorization, albeit they are not themselves regulated entities.
Thank you, Albert. And Atelka, maybe you could kind of finish off our round the world review here.
Sure, thanks, Hannah. We've got a lot of excitement coming up in Hong Kong this year. So currently we have what's called an opt-in regime for digital asset trading platforms that list at least one token that qualifies as a security, because otherwise the securities regulator has no purview over these systems. At the moment, we have one exchange that's licensed under this regime in Hong Kong. We're expecting significant changes to this regime this year or next year, depending on when the legislation goes through, whereby essentially any entity that carries on business in Hong Kong as a virtual asset exchange will need to become licensed. This is to implement the FATF rules within Hong Kong. Virtual assets will comprise really a very wide spectrum of tokens, which will bring most types of exchanges within the regime. And one of the important facets of this proposal is that these exchanges will be limited to dealing with professional investors only. So that's going to have quite wide ramifications for the retail market here in Hong Kong. We don't have the draft legislation yet, so we're still waiting for that, and then we'll see more about the details. Thanks, Hannah.
Sorry, trying to unmute myself. Thank you, Atalka. Great. So, I mean, there are kind of clearly fairly common themes and perhaps a kind of similar direction of travel, I think, in most of these jurisdictions, but there are some important differences in the details. And we have, I think, in some jurisdictions got the AML regimes almost kind of filling I guess, what might be seen as a gap in terms of regulation, other type of regulation of crypto exchanges at the moment. And so it is really important not to forget those AML related requirements, because they are in some cases doing more than what might just look like it's about AML. So on that note, should we move on to the next question, number 3, which was really kind of developing this theme of regulation, but thinking about regulation on a more cross-border basis, because I think we all know that crypto exchanges, perhaps even more so than traditional exchanges, generally want to be operating on a global basis. And that might not just be in terms of the countries where they want to have customers, but also actually the countries from which they might actually want to operate. And so the question here is really, to what extent is that possible? And are there potentially any particular or special arrangements for this in this world, either now or maybe also in the future? So, Ron, maybe we could start off with you in the US on this question.
Sure, absolutely. And I think the US regulators generally take a very broad view of their jurisdiction in this area, and that would include really any platform that operates from the US or engages with persons residing in the US. And so there are quite a number of jurisdictional hooks, or a broad range of jurisdictional hooks for the US regulators to believe that they have the authority to intervene and take action. And within that scope, there may be some narrow exemptions available, such as in the case of trading crypto securities for offshore platforms that would limit participating US persons to banks and broker-dealers. Generally, though, I think that the message is that there's going to be a broad view of jurisdiction taken in the US.
Thank you. Yeah, thank you, Ron. I think we're actually probably all fairly aware of that, but it's good to be reminded. I think actually it's maybe not so dissimilar in the UK. Albert, do you want to say a few words about that?
Yeah, sure thing. So here in the UK again, sort of the context of the jurisdiction is again fairly broad. Typically where we typically take kind of the regulators here take ownership of matters which are typically performed from the UK. So if you are carrying out activities from the UK establishment in operating a crypto exchange or providing other services, then they would likely determine that you are in scope. One of the things to bear in mind is we have a variety of different approaches that have been built over the years around how we treat overseas persons who are performing certain activities under our regime. Our AML regime is principally focused on firms that are operated from the UK, whether that be through a registered office or, for example, through a head office where decisions on that activity are made. So, under the AML regime, if you were, for example, operating in the US and you were providing these services to customers in the UK, if you're not substantially performing those activities from the UK, then you wouldn't fall in the scope of our AML regime. However, we're now seeing, with the latest consultation, the intention to expand our financial promotions regime more broadly in the UK, and that does have, again, sort of extraterritorial effect because it impacts on promotions that are applicable or capable of having an effect here in the UK. So it can capture people who are not necessarily based here. So I think there is a kind of inevitably with all jurisdictional questions a sort of thorny path to navigate to ensure whether or not you are offshore and whether you're not. You would have seen in the market there are some providers who've taken a fairly robust view to being offshore, and that being a kind of solution to all of these kind of regulatory issues, and that if there's no presence in the jurisdiction, then there is nothing that the regulator can in fact do. Others have clearly taken a slightly different approach to that, and I think that's borne in mind by regulatory relations and also cooperation between regulators. I mean, it cannot be ruled out that we're going to be in a situation where all of this activity is regulated almost universally across jurisdictions. So I think, from a specific UK standpoint, there is there is, again, complex questions on jurisdiction to try to determine, and it certainly isn't a one size fits all. And before I finish, Hannah, maybe just a point, I think, on contextual point on this is that one of the things to bear in mind with crypto regulation, and sort of subject to when we get MiCA in, as Floortje has been describing, we really don't have any form of harmonized regime across jurisdictions. So very much we're in a kind of member state by member state approach. And I think one of the things many people, and I'm sure people on this call have advocated for, is some form of kind of commonality in international standards, or in a commonality in approach to regulation, because we're seeing jurisdictions not regulating crypto, some jurisdictions regulating it in different ways, some jurisdictions treating it like banking activity, some treating it like investment activity, some banning it all together. And I think when you have that fragmented approach to regulation, there is that arbitrage, and that arbitrage makes it difficult for operators to launch kind of collective go-to-market plans. And so I think when thinking about cross-border activities in crypto, it's important to understand and to recognize that you may need to develop a tailored approach to each market, and that approach may not necessarily be a common approach, which obviously increases costs and can impact kind of go-to-market timeframes. So I think there's very real, there's an interesting regulatory debate here. There's also a very real kind of practical, operational and commercially impacting set of circumstances for crypto exchanges and other providers in crypto looking to expand internationally.
Yeah, that's absolutely right. Thank you, Albert. Floortje, do you want to just pick up briefly on that MiCA point?
Yeah, so I think also already currently it ties into what Albert already says. I think, for instance, in the Netherlands, it is now considered whether you're active in or from the Netherlands. So indeed, also if you're abroad, but you're offering your crypto exchange platform to Dutch citizens, then you're being considered to be active in the Netherlands, and therefore you would need to have that registration, and that would be the same under MiCA. So in that sense, they indeed don't look only for where your establishment is, indeed, because sometimes you don't even have a legal entity that is sort of, well, operating, say, the system, let me put it that way. So I think that does make a difference. But what the effect is that in order to then become registered, you need to have a Dutch entity. So they sort of then pull you on shore. So it's sometimes a bit contradictory. And what we have seen, for instance, in relation to the current registration obligation, is that some entities take the approach that they look at the initiative test, so whether or not they are actively marketing their services or platforms in jurisdictions. And if they are not actively doing that, then they are not considered to be active. And then the fact that, say, for instance, Dutch citizens or German citizens will find that platform, it doesn't trigger the obligation for the registration. And that might be different, I think, going forward as well. But so that, yeah, what Albert says, that sort of resonates, I think, in Europe as well.
Thank you. And Detalco, is there anything you'd like to add from a Hong Kong or maybe Asia perspective?
Yeah, quite a similar story here, actually. And the new proposed regime that I mentioned earlier will include a sort of active marketing provision, which sounds quite similar to what Floortje has been describing. So essentially, even though generally Hong Kong law doesn't have extraterritorial reach, there will be a provision which essentially means that if you're an overseas exchange and actively marketing to Hong Kong, to the Hong Kong public, essentially, then you'll need to come on shore for licensing purposes. So there'll be some work around the analysis of what that actually means in practice. So very similar themes from here. Yeah.
I mean, as you say, kind of similar themes, I think, from most of the jurisdictions. But again, kind of these differences in the actual requirements that apply and how you comply with them, can make it quite difficult actually for exchanges that want to operate cross-border really to be able to do so. And we often get asked the $1 million question, I think, kind of what's the best way to do this globally, or where's the best place to set up? And I don't think there is a kind of single answer to that at the moment. That's a really tricky one. Okay, right. So I'm just kind of a bit conscious of time. We should perhaps move on to the next question, which is looking at some of the kind of characteristics of crypto exchanges that maybe make them a bit different to, I've said normal exchanges, but we mean traditional asset exchanges. Is we've kind of talked about the fact that actually some of these crypto exchanges can look quite different to the traditional securities and derivatives exchanges, but we kind of wanted to maybe dig into a bit more detail on what we really mean by that, because I think there are some fairly kind of interesting and novel and frankly evolving features to them. So Floortje, do you want to start us off on this one?
Sure, and I think the one that I wanted to raise is the differences of who will have access to the exchanges. So if you look at the traditional exchanges, typically only large regulated activity or entities could become members of the platforms, and then in the end, at the end of the whole trading chain, there is the consumer and the retail person. And that is different with the crypto exchanges. So there, typically, you have as a consumer, you have you can have the direct access to the platform, and that is, I think, also something that has been acknowledged. So in Europe, there is now also a proposal for a pilot regime for exchanges using blockchain. And there, indeed, one of the aspects that is being sort of now contemplated on how to deal with that is indeed with the fact that there might be different, so the trading will be different because it will be directly done by the retail persons instead of by institutional trading entities. So I think that is an aspect that is different, and that is also currently not something acknowledged in the rules and regulations for the traditional exchanges, but might be different in the future. So that pilot regime, it's a proposal. Hopefully by the end of this quarter, I think there should be an agreement and a publication, but that might take a bit longer, and that would mean that certain MTFs could have a period of 6 years for operating such a trading system on blockchain, whereby indeed they will have retailers or consumers as a direct member to the exchange, and then therefore certain rules will apply and certain rules will not apply going forward.
Great, thank you. Albert, do you want to, I don't know if you want to add anything to that or talk about any other features that might be interesting?
Yeah, so just to add to that, and then I've got a couple of other points. I think there's one of the things is, to the accessibility point that Floortje was discussing. I think you often find then that the kind of outward customer experience in terms of the tech and the user interface of crypto exchanges is representative of that accessibility. You cannot go on, there is not an app that you can use to trade, on some of the largest regulated markets and MTFs that we have. You typically need to access those markets through brokers, and there's intense kind of, trading applications and all forms of trading software and APIs on that connectivity. But, for trading exchanges, even the most kind of beginner functionality scaling up to the more advanced, there's all sorts of accessibility and technological components to that accessibility. So I think one of the things, the differences is they're utilizing advances in user experience, in design, in interface design, in technology through mobile applications, etc., to give people access in a far more kind of simplistic fashion, in a way that you would never be able to access a regular exchange. So I think that's one interesting component of utilizing that tech and recognizing the customer base and the importance of that interface in actually being a competitive advantage for the exchange. How easy is it to trade is a pretty important element of a crypto exchange, in a way that I think isn't really a relevant factor for many exchanges which are fundamentally institutionally facing. I think another couple of points, and these are interlinked, is one is the sheer almost kind of multifunctionality of exchanges compared to traditional financial services exchanges. So I think clearly one can see with Eurex and LSEG. These are significant financial institution groups, many of them whom provide all sorts of different services. But I think often that they're housed in different entities, they're housed in completely different, they've got different strategies, and they play a whole role in the market infrastructure piece. And I think what we're seeing with crypto exchanges is that they're also providing these ancillary services. Many centralized exchanges often also offer custodial solutions. They provide, they're moving into kind of lending, crypto asset lending. They're moving into sort of point of sale payment propositions whereby you can utilize functionality. There's staking services. They have peer-to-peer wallet payment transfers through crypto wallets maintained on the platform. So I think the scope of the services are really expanding, and in a way that I think we have seen in traditional financial services, but I think here there's more of that consumer element. And so some of the services are in fact geared more towards that kind of those consumer-based the demographic of the users of the relevant exchange. And I think that can lend to an interesting concept, and I think a question has been raised on this, which is, overall, how do you manage conflicts and in a way in this environment, in a way that you typically would see in traditional financial services? And that's something, our institutional clients have raised issues with when they are thinking about onboarding with large exchanges. There is, because of the fact that we largely do not have a market abuse regime for many of these types of assets, and because they're not caught within kind of conduct of business MiFID style conflicts rules, you can find there's instances of, you can have front running on positions, you can have, kind of pump and dump style schemes, sort of shilling of coins. All of these types of things, inside information is not technically a thing because it's not non-material public information, non-public material information. So you have a situation where, there is no kind of baseline legal requirement to manage those conflicts and to protect those kind of abusive style practices. I think many institutions are trying to integrate, sort of ethical and good practice arrangements. But I think, if you look at, that's a stark difference between regular exchanges. They have to really think about utilizing group entities on a conflicts basis and how that is in the best interest of customers and users of the exchange. And I think that's not always something you typically see for crypto exchanges. So I think one area, it wouldn't surprise me, even if we don't get full regulation, would be kind of increasing regulatory pressure to try to voluntarily comply with the market abuse regime and to comply with kind of MiFID style conflicts obligations.
Yeah, no, absolutely. I think that actually might lead us quite nicely on to the next question, which is where we wanted to look at some of the key differences between the way in which perhaps traditional asset exchanges are regulated versus the way that, well, if you were to then take that regulation and apply it to crypto exchanges, kind of how would that work, and where would there be some potential challenges or even gaps, because the existing regulation has been designed with particular asset classes in mind. And I think maybe if we, since you kind of started to touch on it, it might be quite good to ask Etelka to talk a bit more about the kind of market abuse angles. Is that possible, Etelka?
Yeah, absolutely. I was thinking about that when Albert was speaking. So look, that's a really interesting topic in this sort of crypto space, and one that is getting increasing attention. Market manipulation has really existed as long as there've been any type of tradable assets, and cryptocurrencies are really no exception to that. I mean, the issue is that obviously this space is still quite immature in some respects. Regulations are not yet in place, and therefore these types of markets are more vulnerable to market manipulation in a way that's not that easily possible with more mature markets. But in reality, it's just like any other market manipulation. We all know wash trading, layering, pump and dump that Albert mentioned. We know all these from the securities markets. It's just that those are really highly regulated now. There's a lot of market surveillance being done by both the exchanges themselves and by the regulators, reporting, auditing, all of that. The schemes are quite well known. Pump and dump, that's probably the most pervasive one in the crypto markets and has the highest impact. We've got the so-called whale walls, which was visible in some of the prior sort of Bitcoin cycles, somewhat less prevalent today. In the sort of traditional markets, this is what's called order book spoofing, essentially where a participant places a large order with no intention of ever having it executed, essentially creating the illusion of a large demand. We've got stop hunting, which is essentially participants looking for stop loss milestones, thereby forcing action from market participants out of their positions, driving prices lower. So we've seen all this. What's really interesting, and that seems to be a sort of a newish phenomenon in this market, which is also now leaking into the traditional markets, which is what's sort of called FUD, fear, uncertainty, and doubt, which is essentially a sort of a manipulation technique that can move crypto prices without even buying or selling. And this is where the role of KOLs, influencers, Reddit and these types of platforms and creating negative news is really having an impact. So that's an area that we're all watching with quite some fascination. And obviously then there's the sort of adjacent issues that Albert has mentioned around conflicts, etc. So we expect that there's going to be a lot more interest from regulators in this particular area of crypto regulation.
Yeah, absolutely. I think there's quite a lot more to come on this particular topic. I think the other kind of angle that is maybe tied into this is some of the kind of transparency and reporting requirements that have, are very well kind of understood as necessary for the crypto asset, traditional asset exchanges, but kind of question how they would potentially work or whether they're even necessary in this crypto context. Floortje, do you want to say a bit about that?
So like you said, in Europe, and I think it's quite global, is there's quite used to the fact that traditional or the normal exchanges publish the pre and post trading information, so in relation to the transactions on the platforms, and also reporting of the transactions towards the regulators to indeed use for spotting market abuse. Currently, that's not in place. That will, on the European level, come into play in relation to MiCA and the pilot regime that I just referred to. So they are catching up to the fact that indeed these crypto exchanges have similarities and therefore need to have a similar regulatory framework as well. So on the transparency, the rules that apply to the normal exchanges or traditional exchanges will come into play as well for the crypto exchanges. And what you see is that indeed regulated. I think one of the questions was also how do regulators keep informed and have the same pace? I don't think they will ever, to be honest. I think we have seen sandboxes everywhere. They really want to be sort of front and center, but typically they are a bit behind. And that's what we see also with the rules and regulations. They are now trying to amend and get a new system in place or a similar system in place, but it takes time to get all those rules in place. And then now there's discussion because of the fact that technology is different and how does it work, and therefore the rules need to be amended. So it's interesting to see, but there's a lot coming, I think, this year and next year in relation to the crypto exchanges and the regulatory framework that applies.
Yeah, no, absolutely. Okay, so kind of conscious that we've only got about 5 minutes left. If we, the last question we had was really trying to look at some of we've obviously focused on exchanges or the operators of trading venues. And we wanted to just kind of say a few words about other rather important participants in this ecosystem, so other service providers. I think we've kind of touched on some of those, but maybe there's a few that it's maybe worth saying a little bit more about. Albert, do you want to do that? But also, we did have some interesting questions about DeFi along the way. I don't know if you might be able to bring some of that in.
Sure thing. So I think in terms of the types of service provider, I mean, I think I've sort of alluded to the fact that there's been sort of real, like any marketplace, it thrives on its liquidity. So there's been, you know, a significant enhancement in the number of crypto market makers who are typically algorithmic trading firms trading their own proprietary capital, and being willing, like many traditional market makers, to put out bid and ask spreads in various crypto pairs. And many of them are trading across a whole array of different exchanges on DeFi venues. So they're deploying sort of specific DeFi trading strategies. So, you know, often, again, and I think maybe this is a segue into DeFi, you know, particularly in those swap networks, you know, there is a recognition that if you're on there as an individual trading your tokens in a swap capacity, like say on Uniswap, you may very well be trading against someone who is significantly more sophisticated than you are in the context of your trading. And many, you know, many people on DeFi exchanges are deploying kind of traditional, they're deploying effectively their own liquidity trading strategies, utilizing their own kind of tokens to try to you know, generate returns on those on those trades. So I think that's worth bearing in mind. I think as a little segue, in terms of the questions we've had, there's been some really interesting questions on DeFi, and I think everybody is rightly asking the same question, which is how would anyone really even approach DeFi? And I think, you know, the whilst many regulators have developed, you know, a technology, you know, a technology neutral approach to regulation, I think that the sheer nature of decentralization really calls into question how far we can stretch that notion. You know, if you're doing something on paper and pen versus whether you're doing it on a computer, in theory, if you're selling investments or buying shares, you should be subject to the same rules. That is incredibly difficult to have when you have, you know, effectively autonomous pieces of code dictating the actions, you know, dictating how things pan out on these venues. Also, you have community-led governance, and so, you know, necessarily actions which can typically be enforced against an operator or a legal person, it's unclear exactly against whom they will operate. They would be enforced, and that's the key difference. You know, regulation typically attaches to persons. It's incredibly rare in the law for regulation to just apply to concepts on notions, or, you know, or extensively large groups of people. And so the question remains in the context of DeFi is against whom would any rules be enforced, and how would that even go about? You know, you cannot require a DAO as a concept to be regulated, but, you know, under a legal form, most DAOs are typically seen as general partnerships in most jurisdictions. So in theory, you could require everybody behind the DAO or anybody who's a participant in the community to be regulated, but then you might have 150, 1,000 people regulated in connection with the operation of a exchange, which makes little sense in the typical, you know, the way we typically think about enforcement and regulatory obligations. In many instances, you know, the algorithms can't really be stopped. You know, once they're deployed, they're functioning, they're autonomous, and they can only really be brought to heed or suspended with majority community input. And so again, if you don't get that, then the actions that the FCA or other regulators want to see occur can't necessarily be achieved. And I do think we will enter into a very interesting dynamic, dependent on how the growth of DeFi continues, where, you know, persons who are involved in the software development, you know, perhaps multi-sig signatories who are playing a role in a treasury function of a decentralized project, I think more and more will be looking at their own regulatory risk and thinking, well, you know, if we deploy the original smart contract, will the FCA or other regulators be looking at us as the person who should be regulated? But, you know, again, typically persons who just create technology and don't necessarily deploy it aren't necessarily regulated. So again, there's some really kind of difficult theoretical, philosophical, as well as operational questions that arise. And I think, you know, it's sort of very loyally answer, for which apologies, but you know, at the moment, it's really hard to see exactly how you know, regulators will adapt to DeFi. You know, and with that comes, you know, high degrees of uncertainty for DeFi projects. And so again, I think with DeFi, we're slightly the regulators are on a slight time lag, in the sense of most regulation works retrospectively. Something new comes out, the regulator assesses it and it adapts. And I think with we've gone from traditional exchanges to crypto exchanges, which is a big enough leap. And then we've moved almost kind of a quantum leap into decentralization. And I think there is going to be a time lag as regulators consider how they adapt. But I certainly don't rule out the possibility that any regime that's implemented for crypto is defined in such a way that it's simply not possible for DeFi propositions to comply, and that then may therefore impact their deployment and their general take-up. Sorry, I've kind of hogged the last few minutes there, Hannah. Apologies.
No problem. I mean, I think that probably does bring us to an end, but thank you for attempting to answer some of the questions that we had, Albert. That was great. I mean, thank you everyone also for joining us and for listening. Hopefully you found it interesting. I think, you know, that we could probably talk for another hour at least on this topic, because actually there's so much evolution and sophistication in these markets, and actually also some really interesting and difficult questions about the way that regulation either does apply now or might apply in the future. For anyone who is interested to kind of read or hear more, then we have various sources. We have some blogs, some podcasts that we publish regularly, both on financial services topics, but also on fintech topics. So please do look at the various sources that we've got on the screen now. Equally, if you'd like to engage with any of us after the webinar, then please feel free to reach out. But in the meantime, as I say, thank you very much, and thank you very much also to our panelists. So Ron, Etelka, Albert, Futcher, thank you.
Thanks very much to the team at Norton Rose Fulbright for organizing today's podcast webinar, and we will be sharing a recording of this with everyone who registered. Thank you. Have a great rest of your day.